All right, let's dive right into this explainer and solve a pretty massive accounting mystery. We're looking at exactly why your corporate books might suddenly and inexplicably disagree at the end of the year. If you've spent any time at all looking at corporate financials, you know that balance and harmony, well, they're the ultimate goals, right? Everything absolutely has to tie out. And getting this right isn't just about making the math look pretty. It's absolutely crucial for preventing audit failures, securing investor confidence, and for sure, ensuring your tax filings don't trigger massive penalties. But every now and then, we run into this fascinating situation where the numbers simply do not align, even when everyone is doing their jobs perfectly. So today, we're going to play financial detectives. We're going to look at the exact mechanics of why an account maintained at a branch location might suddenly show a totally different balance than the corresponding account sitting back at the head office.
We're starting with a classic financial whodunit. At the exact end of the accounting year, why do two sets of records that should mirror each other perfectly suddenly show completely different numbers? Picture the scene. It's the final high-stress day of the accounting year. The bookkeepers at the head office run their reports, and the folks out at the regional branch run theirs. In theory, the amount the branch owes the head office should match the exact amount the head office claims the branch owes them. It's supposed to be a flawless, symmetrical relationship. But suddenly, there's a mismatch. Sometimes it's just a few dollars, sometimes it's literally millions. And here's the kicker. It's not fraud. Nobody embezzled anything. It's not a mathematical error or some broken spreadsheet formula either. So, what exactly is going on here to cause this end-of-year panic? Now, what's really interesting here is the stark contrast, and honestly the mild panic it represents when the account maintained at the branch completely disagrees with the paired account back at HQ. Let's break down how this reciprocal relationship is actually structured. On one side, we've got the head office account. Now, keep in mind, this specific account is maintained out in the branch's local books. It tracks what the branch owes the central hub. Over on the flip side, we have the branch account. This one is maintained at the head office, tracking what the central hub is owed by that specific branch. They're reciprocal accounts, so an entry on one side should trigger a perfectly mirrored entry on the other. But, as we're about to see, the messy physical world doesn't always want to cooperate with our clean, abstract accounting rules.
So here's the crucial point. Our master culprit is this concept of being in transit. It's basically a sort of financial limbo where items exist in the real world, but they belong to no one's completed accounting records at that exact second. This right here is the heart of our mystery. When we say something is in transit, we mean it has officially left the sender's building, but it hasn't actually arrived at the receiver's loading dock or bank account yet. The item is literally out there on a truck, rumbling along on a freight train, or just floating invisibly through the banking system. The headache arises because the sender has already dutifully recorded the departure in their books, but the receiver, well, they can't legally or logically record the arrival until they actually have the item in their hands. Whether it's a massive cargo ship delayed by a storm or a long weekend bank holiday abruptly pausing a wire transfer, this physical timing difference is exactly what shatters our perfect accounting mirror.
So, let's look at culprit one, goods in transit.
Let's investigate this first suspect, which is the physical movement of inventory from headquarters to a specific branch location. This timeline brilliantly illustrates the exact moment the mismatch happens. Think about step one. The head office packs up a large shipment of valuable goods and puts it on a truck bound for the branch. The exact moment that truck leaves the facility, the head office does its job. They immediately debit the branch account in their own books, basically declaring, hey, the branch now officially owes us for these goods. But then the timeline hits step two. The absolute end of the accounting year arrives. The corporate books must be closed. However, those goods are still out on the highway somewhere. It won't be until step three, completely post-close, that the branch actually receives the goods and can finally credit their head office account.
The reality is pretty simple. Because the branch hasn't physically touched those boxes yet, absolutely no entry can appear in their books for these goods in transit. And boom, that breaks the mirror between the accounts. It actually makes perfect logical sense when you put yourself directly in the shoes of the branch manager. You are certainly not going to record a massive influx of inventory that you haven't inspected, counted, or even unloaded yet. If you did record it and that delivery truck got lost or hijacked, your branch's books would be wildly inaccurate. So the branch follows strict protocols and just waits. But because the head office also strictly followed the rules and recorded the dispatch the second it left their dock, we end up with this temporary, yet highly stressful disagreement right at the most critical moment of year-end reporting.
Now for culprit two, cash in transit.
Let's move to our second suspect and see how this whole situation builds when we talk about actual money moving between the two entities. Because cash is constantly flowing back and forth, right? Just like the boxes of inventory, cash remittances get caught in that exact same limbo. It keeps the money unrecorded at the receiving end and directly causes a massive headache for the bookkeepers. Say a branch is sending its final monthly profits back up to headquarters. If that cash remittance is initiated late in the year, the branch is going to update its books to show the money leaving. They've done their part. But if the firm's closing date arrives and that electronic transfer hasn't fully cleared the banking network to actually land in the head office's receiving accounts, the head office cannot legally record it. Once again, the sender has recorded the event, the receiver has not, and our balances are officially in disagreement. It's the exact same mechanical issue as the physical goods, just with financial currency.
All right, so let's look at the resolution, closing the case.
Fortunately, every good mystery has a solution, and there is a very specific mechanical fix to resolve this whole mess before the final company financials are published. To reconcile these differences, we simply follow these 3 steps, utilizing a special adjustment entry to account for those limbo items, and finally prepare an accurate consolidated balance sheet. This is essentially how the accountants save the day. First, they have to put on their detective hats and identify exactly what's in transit. They're looking for the specific dispatched goods and the exact remitted cash that just haven't landed yet. Now, once identified, they can't just forcefully change the branch's books, because remember, the branch still doesn't physically have the items. Instead, a special adjustment entry is passed. This is usually done in the head office's books to temporarily park these in-transit values, so the overall math perfectly aligns. Only after this critical adjustment brings the 2 sides back into harmony can the company proceed to prepare a unified, accurate, consolidated balance sheet for the entire organization, the whole shebang.
I'll leave you with this final thought as we wrap up this explainer. In a world of instant digital transfers, no matter how advanced our accounting software gets, time and physical distance will always find a way to interrupt our abstract financial data. We've seen how tangible goods on a truck and digital cash in a complex banking system create these fascinating temporary blind spots between a head office and its branch. It's a really incredible reminder that accounting isn't just about abstract numbers on a computer screen. It is a profound, highly structured attempt to capture the messy, moving, physical reality of a business at a single frozen moment in time. Thanks for diving into this case with me, and definitely keep questioning the numbers behind the numbers.